Ladies and gentlemen, Asian guy here. Today we are going to read the fine print. We are going to look at the contract that you think you own. We are going to look at the document that supposedly guarantees your wealth, and we are going to find the trapdoor. Because for years, we have operated under a delusion. We have believed that the COMEX, the commodity exchange, the primary price-setting mechanism for silver in the world, is a marketplace for metal. We believe that if we buy a contract and we hold it to expiration and we stand for delivery, that the exchange is legally obligated to hand us a 5,000-ounce bar of silver. We believe that a contract is a contract. We believe that a deal is a deal. But I am here to tell you that in the world of fractional reserve commodities trading, a contract is not a guarantee. It is an option. And it is an option that belongs to the house, not to you. We are staring down the barrel of the greatest default in financial history. We are looking at a scenario where the physical inventory in the registered vaults hits zero, where the demand for delivery overwhelms the supply, and where the exchange simply says no. They won't call it a default. That word is too ugly. That word scares the bond markets. They will call it force majeure. They will call it liquidation only. They will call it cash settlement. But make no mistake, it is theft. It is the legalization of a rug pull on a global scale. And the scariest part, it is written right there in the rulebook. They have been telling us for decades what they are going to do. We just haven't been listening. We have been too busy looking at the charts, too busy arguing about Elliott wave theory, to realize that the casino has a rule that allows them to keep your chips whenever they want. Let's look at the setup. Right now, the ratio of paper silver to physical silver is at historic highs. Depending on how you calculate the eligible versus registered categories, there are hundreds of paper claims for every single deliverable ounce. The system works fine as long as everyone plays the game. It works fine as long as the hedge funds roll their contracts. It works fine as long as the speculators take their profits in cash. The system is designed for speculators. It is designed for people who want to bet on the price of silver, not people who want the silver itself. But what happens when the psychology shifts? What happens when a sovereign entity or a massive industrial buyer or a coalition of retail investors decides they don't want the cash? What happens when they stand for delivery on 10,000 contracts in a single month? That is 50 million ounces. If the registered vault only holds 30 million ounces, we have a mathematical impossibility. In a free market, the price would rise until someone was willing to sell. The price would go to $100, $200, $500 until enough silver came out of hiding to satisfy the demand. But the COMEX is not a free market. It is a controlled market. It is a market designed to manage the price, not discover it. And the banks who run the exchange, the JP Morgans, the Citis, they are the ones on the short side of those 10,000 contracts. If the price goes to $500, they are bankrupt. They are insolvent. The clearinghouse blows up. The contagion spreads to the bond market. The system dies. So they have a choice. Choice A, allow the price to rise, honor the contracts, deliver the metal, and go bankrupt. Choice B, invoke the emergency rules, declare a disorderly market, suspend trading, and force the contract holders to accept a cash payment at a price determined by the exchange. Which one do you think they will choose? Do you think they will commit suicide to honor a promise to you, or do you think they will flip the table and change the rules? This is what force majeure means. It is a French legal term that means superior force. Usually it refers to acts of God, earthquakes, wars, hurricanes, events that make it physically impossible to fulfill a contract. But in the financial world, they have expanded the definition. Now, force majeure includes market disruptions. It includes liquidity crises. It essentially includes, we made a bad bet and we can't pay. Imagine you go to a car dealership. You buy a car, you sign the papers, you pay the money, you go to pick up the keys, and the dealer says, sorry, we ran out of cars. But here's your money back. And by the way, since you paid, the price of cars has tripled, but we are only giving you back the original amount. You would call the police, you would sue. But in the commodities market, this is legal. This is the cash settlement clause. The COMEX has a rule, Rule 589 and others related to emergency actions, that gives the board of directors absolute power to intervene if they deem the market is acting irrationally. If the shorts are getting squeezed too hard, the board can step in, they can halt trading. They can order that trading is for liquidation only. This means you can sell your position, but you cannot buy a new one. This kills the demand instantly. But the ultimate weapon is the forced settlement. They can look at the 10,000 contracts standing for delivery and say, we do not have the metal. Therefore, we are voiding the delivery obligation. We are settling these contracts at the fixing price of yesterday's close. So, if silver closed at $30 yesterday, but the real street price is $100 because there is no metal, they will give you $30. They will wire $30 into your brokerage account and delete your contract. You will scream. You will say, I wanted the silver. And they will say, read the rule book. We settled you in cash. You have your dollars back, but you don't have the silver. And because the real price is now $100, your dollars have lost 70% of their purchasing power instantly. This is the trap. This is why holding paper silver, whether it is a futures contract, an unallocated account, or a shady ETF, is playing Russian roulette with a fully loaded gun. You are betting that the very people you are fighting against will honor the rules of engagement when they are losing. They won't. History tells us they won't. Logic tells us they won't. They will protect the institution at the expense of the individual. They will protect the clearinghouse at the expense of the speculator. The force majeure event is not a possibility. It is a certainty. It is the only mathematical way out of the corner they have painted themselves into. The registered inventory numbers we track every day, the drain from 150 million ounces down to 30 million, this is the countdown clock. When that number gets critically low, the force majeure trigger will be pulled. It won't happen when it hits zero. It will happen before it hits zero. It will happen when the insiders realize there is no way out. They will halt the market on a Sunday night. You will wake up Monday morning to a press release. Due to unprecedented volatility and supply chain irregularities, the COMEX is suspending silver delivery mechanisms effective immediately. And just like that, the illusion of the paper market will shatter. The price on the screen will freeze, but the price on the street will explode. This is the moment of decoupling. This is the moment where the paper price becomes a museum piece and the physical price becomes the only reality. And if you are holding a contract hoping for delivery, you will be left holding a bag of depreciating fiat currency, watching the real wealth sail away on a ship you were kicked off of. We need to understand that the exchange is a club. It is a club for banks. You are not a member. You are a customer. And in a crisis, the club protects its members. The force majeure clause is the shield they will use to deflect the arrows of the market. They will say it was necessary to maintain market integrity. They will say it was necessary to prevent systemic risk. They will use fancy words to justify a simple act, default. Skeptics will say, John, you are being paranoid. The COMEX would never default. It would destroy their reputation. It would destroy the trust in the US dollar. They will print money, they will bail out the banks, but they won't cancel the trades. To those skeptics, I have two words: London Nickel, March 8th, 2022, the London Metal Exchange, LME. This is not ancient history. This is not a theory. This happened barely a couple of years ago, and it is the exact blueprint for what is coming to silver. Let's review what happened with nickel because it is the smoking gun. A massive Chinese tycoon, the head of Tsingshan Holding Group, was short nickel. He was short billions of dollars worth. He was betting the price would go down. But the price went up. It went up because of the Ukraine war, because of supply constraints, and because speculators smelled blood. The price didn't just rise, it went vertical. At $100,000 a ton, the Chinese tycoon was insolvent. He owed billions in margin calls. The banks that cleared his trades, JP Morgan, Standard Chartered, the big boys, they were on the hook. If he couldn't pay, they had to pay. And they couldn't pay. The numbers were too big. The entire clearinghouse of the LME was facing instant death. The system was about to collapse because of one bad bet on one metal. So what did the LME do? Did they let the free market work? Did they force the tycoon to liquidate his assets? Did they force the banks to pay up? No. They did something that shocked the world. They suspended trading. But they didn't stop there. They looked at the trades that had already happened that morning. The trades where people bought nickel at $60,000, $70,000, $80,000. People who made massive profits. And the LME said, these trades effectively didn't happen. They canceled the trades. They retroactively deleted billions of dollars of transactions. They reached into the accounts of the winners and took the money back to save the losers. They rewrote history. They declared that the price was not $100,000. They declared the market was disorderly. They protected the short seller. They protected the banks. And they screwed the longs. They screwed the people who correctly predicted the price move. This is the precedent. The LME is the sister exchange to the COMEX. They operate on the same principles. They are owned by similar interests. If the LME can cancel trades to save a Chinese tycoon, do you think the COMEX won't cancel trades to save JP Morgan? Do you think they won't cancel trades to save the US Treasury market? The nickel squeeze was a test run. It was a proof of concept. It proved that in a systemic crisis, the sanctity of the contract means nothing. The force majeure clause allows for this. It gives the exchange the power to defer, close out, or settle contracts in the interest of the exchange. Notice the language. In the interest of the exchange. Not in your interest. In their interest. Their interest is survival. Your profit is their loss. In a zero-sum game, when the losses become terminal, the rulebook allows them to quit the game. Now apply this to silver. The silver short position is much larger than the nickel short position. It is more concentrated. It involves the too big to fail U.S. banks. It involves the strategic defense stockpile of the United States, or lack thereof. When silver rips to $100, it's not just a tycoon in trouble, it is the dollar itself. It is the perception of U.S. power. The mechanism will look like this. Silver gaps up $10, $20 in a day. The margin calls go out. The shorts can't pay. The price gaps again. The exchange halts trading. Circuit breaker triggered. They keep it halted for a day. They issue a statement. Then they announce that all trades executed above a certain price are void. Or they announce that all open contracts must be settled for cash at the last valid price. This is the cash settlement trap. They will force you out of your position at a price that they determine. Maybe they settle you out at $50. You get your check. But by the time the market reopens, or by the time the physical market adjusts, the real price is $200. You have been robbed of the upside. You assumed the risk of the drawdown, but you were denied the profit of the squeeze. This is asymmetric warfare. And why is cash settlement the ultimate betrayal? Because the whole point of buying a futures contract for delivery is to escape the cash. You are buying silver because you believe the dollar is failing. You are buying silver to hedge against inflation. If the exchange forces you back into dollars at the very moment the dollar is crashing, they have defeated the entire purpose of your trade. They are forcing you back into the burning building. This is why we say, if you don't hold it, you don't own it. It is not a catchy slogan. It is a legal reality. A futures contract is a claim on metal if the exchange functions. A bar in your hand is metal regardless of whether the exchange functions. The counterparty risk in the COMEX is 100%. In the event of a force majeure, you are an unsecured creditor. You are at the bottom of the list. The banks get paid first, the brokers get paid second, you get the scraps. The nickel squeeze showed us that the free market is an illusion. It is free only as long as the right people are making money. When the wrong people, the retail speculators, the independent funds, start winning too much, the game is stopped. The rules are changed, the tape is rewound. We must internalize this lesson. The COMEX is not a vault, it is a betting parlor. And like any crooked betting parlor, if you break the bank, they don't pay you. They break your legs. Or in this case, they break your contract. The force majeure is the baseball bat they keep behind the counter. They haven't had to use it on silver yet because they have been able to manage the price with spoofing and paper dumps. But when the physical shortage becomes undeniable, they will reach for the bat. They are preparing for this. Look at the rule changes over the last few years. Look at the expanded powers of the Risk Committee. They are fortifying the legal wall. They are writing the permission slips they will need to steal your wealth. They know the squeeze is coming. They know the math doesn't work. And they have decided that when the ship goes down, they are taking the lifeboats, the metal, and leaving you with the anchor, the paper. We have talked about the how, the rules, the cash settlement. We have talked about the precedent, the LME Nickel squeeze. Now we need to talk about the why. Why is this inevitable? Why can't the government just bail them out and let the delivery happen? Why must they force a cash settlement instead of printing the money to buy the silver? The answer lies in the specific nature of silver as a strategic asset and the devastating impact of a true price discovery event on the bond market. You see, if the COMEX were to default honestly, meaning they admit they don't have the metal and let the price go to infinity, it would trigger a cascading cross default across the entire derivatives complex. Silver is not just a shiny rock. It is a collateral asset. It is used in complex hedging strategies. If silver goes to $500 overnight, the interest rate swaps that are tied to the balance sheets of the banks that are short silver would blow up. It is a daisy chain. Bank A is short silver. Bank B is the counterparty to Bank A's bond portfolio. If Bank A dies from a silver spike, Bank B dies from the bond collapse. The Federal Reserve and the Treasury understand this. They know that the commodity derivatives market is the Achilles heel of the system. It is the one place where leverage meets physical reality. You can print infinite dollars to patch a hole in the stock market. You can buy bonds to fix the yield curve. But you cannot print a silver bar to satisfy a delivery demand. If they allowed the physical price to dictate the settlement, the transfer of wealth would be too large. It would bankrupt the establishment. We are talking about trillions of notional dollars moving from the hands of the elite to the hands of the apes, the stackers, the common people. The system is designed to prevent exactly this kind of wealth transfer. They will destroy the integrity of the market before they allow the wrong people to become rich. Therefore, the default is a systemic necessity. They must break the link between paper and physical to save the banks. They have to sacrifice the COMEX to save the dollar. By declaring force majeure and settling in cash, they act as a firewall. They contain the explosion. They say, okay, the silver market is broken. We are closing it. Here's your cash. The game is over. By doing this, they prevent the insolvency of the bullion banks. They stop the bleeding. They sacrifice the credibility of the exchange. Yes. But they calculate that the public has a short memory. They calculate that most people don't understand futures markets anyway. They will spin it as protecting investors from volatility. They will spin it as a necessary measure to stabilize the supply chain. But the real reason is simply there isn't enough silver. The deficit is structural. We are consuming more than we mine. The stockpiles are gone. The military needs it. The solar industry needs it. The electric vehicle industry needs it. If the price were allowed to float freely, it would destroy the economics of the Green New Deal. It would make solar panels unaffordable. It would make EVs too expensive. So the force majeure is also a tool of industrial policy. The government cannot afford $500 silver. It would crash the manufacturing sector, so they will use the COMEX default to essentially nationalize the remaining stockpile. By voiding your contract, they are effectively seizing the metal that was supposed to go to you and redirecting it to strategic industries. Think about it. If there are 50 million ounces in the vault and 50 million ounces of delivery demands, and the government invokes the Defense Production Act, who gets the metal? You, the speculator, or Raytheon? You, or Tesla? The force majeure on the exchange is the first step in strategic rationing. They kick you out of the line so the VIPs can eat. This creates a scenario where the price bifurcates permanently. The official price, the cash settlement price, might be capped at $50. The government might say, silver is $50, that is the fair price. And they will settle all contracts at $50. But in the real world, in the black market, in the peer-to-peer market, silver is trading for $200. This is the ghost market. The COMEX becomes a zombie exchange. It still lists a price, it still trades paper, but nobody takes delivery anymore because delivery is impossible. It becomes a purely synthetic betting index, like betting on the weather. The link to the physical world is severed completely. This happened with gold in the 1930s. The official price was $20.67. Then they confiscated it. Then they revalued it to $35. But you couldn't own it. The market was broken by decree. We are heading for a similar event, but this time it will be executed by the exchange clearinghouses rather than by executive order, at least initially. The systemic necessity of this default means you cannot beat them by playing their game. You cannot beat the house by counting cards if the house can kick you out and keep your chips. The only way to win is to not play at the COMEX table. The only way to win is to take your chips off the table before the force majeure is declared. Once the declaration is made, the lawyers take over. And do you have better lawyers than JP Morgan? Do you have better lawyers than the CME Group? No. You will be tied up in litigation for 10 years while your cash settlement inflates away into nothingness. The class action lawsuit will get you pennies on the dollar in 2035. This is why the warning is so urgent. The window to exit the paper market is closing. The force majeure is the lock on the door. And then once it clicks shut, you are trapped inside the burning building with a bucket of cash that is catching fire. The systemic necessity argument guarantees that they will not hesitate. They will not blink. They will default on you without a second thought to save themselves. So, what does the world look like the day after the COMEX declares force majeure? What does the Tuesday morning look like after the Monday massacre? The sun will still rise, the markets will open, but the financial landscape will be irrevocably changed. The mask will have fallen off. The headline on Bloomberg will read, COMEX suspends silver delivery, cites supply irregularities. Cash settlement implemented. The pundits will be on TV trying to calm the public. This is a temporary technical measure, they will say. This is to ensure orderly markets. Silver is still a safe investment. They will lie, but the charts will tell the truth. The paper price of silver on the screen might drop. It might go from $35 to $28 as the forced liquidation hits. But the stocks of the miners, they will halt. Then they will gap up 50%, 100%. The price of physical coins on eBay, they will double overnight. The premiums we talked about in the unobtainium scenario, they will become the entire price. There will be no spot price anymore. There will only be the get it if you can price. The decoupling will be absolute. This is the moment of the great wealth transfer. The people who were holding the paper contracts, the hedge funds, the unallocated accounts, the ETFs that rely on COMEX delivery, they will be wiped out in real terms. They will get their checks, but they will realize too late that they cannot convert those checks into assets. But the people holding the physical metal, you, the stackers, you will be the kings of the new reality, because suddenly the illusion is gone. Everyone knows that the emperor has no clothes. Everyone knows that the paper promise is worthless. The trust in the financial system evaporates. And when trust evaporates, value rushes to the only thing that doesn't require trust: gold and silver. This event will likely trigger the collapse of the other paper exchanges. If the COMEX defaults on silver, who trusts the LME? Who trusts the Shanghai Gold Exchange? Who trusts the bond market? The contagion of distrust is faster than a virus. It will create a run on all physical assets. Land, art, collectibles, commodities, anything that is not a digital promise from a bankrupt institution. We will see the rise of new exchanges, decentralized exchanges, exchanges based in Singapore or Dubai or Moscow that are fully allocated. You bring the metal, we trade the metal. No fractional reserve, no rehypothecation. The center of gravity for global finance will shift from west to east, from New York and London to the places that actually hold the physical commodities. The COMEX default is the suicide note of the Western financial system. It is the admission that they have run out of real capital and are running entirely on reputation. And when they spend that reputation to save the banks, they have nothing left. For the individual investor, the day after is the day of vindication. It is the day where all the arguments at the dinner table, all the ridicule from family members who said gold is a pet rock, all the frustration of watching the price be smashed, it all pays off. You weren't wrong. You were just early, and now you are right on time. But it is also a dangerous time. A world where contract law has broken down is a chaotic world. Governments may try to implement price controls. They may try to tax windfall profits on metal sales. They may try to demonize hoarders. You must be prepared for this. The force majeure is not just a financial event. It is a political one. It signals the end of the rule of law in markets. You need to understand that your physical stack is your independence. It is your opt-out clause. When they force majeure the contract, they're trying to force you into their system. By holding physical, you are force majeuring them right back. You are saying, I have the superior force, I have the asset, you have the paper, I win. So, as we conclude this series of reports, the message is clear. The legal framework for the default is already in place. The precedent has been set by the LME. The systemic necessity is undeniable. The physical inventory is draining. The clock is ticking. Do not wait for the press release. Do not wait for the email from your broker saying your position has been liquidated. Do not wait for the force majeure. Act now. Become your own central bank. Become your own clearinghouse. Take delivery yourself before the exchange decides that delivery is no longer an option. The COMEX is a machine designed to separate you from your wealth. And for 40 years, it has done this by suppressing the price. In the final act, it will do this by canceling the delivery. Do not be the victim of the fine print. Read the writing on the wall. The default is coming. The settlement will be in cash, and the cash will be trash. Get the metal, hold the metal, and watch the paper castle burn from the safety of your own physical fortress. I am John, AG. The force majeure is not a risk, it is a plan. Make sure you have a plan of your own. See you on the other side of the default.